All right, looks like we're live. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker GOLD, Barrick Gold Corp. Give me 1 second to double check a few of the stream settings and make sure everything's up and running and buffering and all that. Sorry for missing the scheduled stream yesterday. Had some things come up, but I was able to make good use of the time and hopefully fixed a few issues that I've had with streaming between multiple platforms for the last few times. Some problems that have been brought to my attention, so hopefully those are actually fixed now. Specifically getting like the scheduling for YouTube events to work appropriately, which I think it worked. It looks like it worked. Before, when I was trying to set up events, I could set up a YouTube event, but then when I streamed, it would enter a separate event, not actually making people who had set up to have the notification for the event. They wouldn't actually get the notification when the point went live. It basically just told you there was going to be a stream the next day, but didn't actually give you the notification because it set up a new event whenever I went live compared to the one that I had scheduled. But I think I have that problem fixed, so it looks like everything worked, but can't really know 100% on every detail until the end. Anyway, so we'll get into the company now. Barrick Gold Corp, company we've covered a few times on the channel before. Gold miner, though increasingly also a copper mining company. Very successful year for them, also with the relatively high average gold price throughout the year, as well as pretty much about at the same level of price as it was last year, as well as they've managed to achieve a lot of their deleveraging goals over the last few years. They're now pretty significantly net debt position has been brought down into a net cash position. Lots of cash on hand, and then they've also done a lot of shareholder return bolstering through the last few years. They've been increasing the regular dividend pretty drastically over the last several years, but last year they also had a significant extra return on capital dividend that they had put out for shareholders last year, which was really good, as well as they've been doing some significant share buybacks. Now, they also put a new plan in place for more, which we'll get into a little bit later on in the stream. We're not going to cover that necessarily right now. I do like this map right here. Mikey. They have this map right here of all their mines, so I just want to bring that to know. It's always good to have an idea of all the properties they have. They are either the first or second largest gold miner globally. At any given year, it kind of trades between them and Newmont Gold Corp. I think they are currently still the largest by assets, but they do kind of trade that position off a little bit back and forth. They have this guidance page right here, which we're going to get into a little bit later as well. Before we get into all the other numbers, coming back to our watch list with our schedule for companies and stuff, I was originally planning to cover Jefferies today, before I saw that literally last minute that they had put this out, and I was kind of preparing both of these valuations up front because I was really excited to get my valuation for Barrick done quickly. So you can expect Jefferies to be the stream that we'll be doing on Monday. It's basically what I'm getting to on that, and then no telling when KR, one of the other companies that's in our holdings, will show up, but hopefully it'll show up at some point in the near future. And then I am still hoping to do Quest Diagnostics at some point as well. So before we get into all the numbers, I'll cover some of the prep work that I've covered for Barrick, as I normally do. When it comes to gold mining companies, I use an R&D capitalization method that I use for like tech companies as well, but instead of R&D, it's exploration costs that we consider to be their development costs. So I use the exploration costs and amortize them back, but the rate at which I choose to amortize them back depends on the amount of reserves they have and the rate at which they use their reserves. That's a little bit of an interesting methodology that I use for determining essentially how to amortize their exploration and development costs. So we've done that essentially and found out that essentially they have 12 and a half or so years worth of reserves in gold, as well as 33 38.8 or 34 years or so worth of copper. It's worth noting that's partially due to the fact that they don't have as much copper production relative to gold. So if they speed up their copper production, this amount of years could, could significantly drop, perhaps to be only about as half as much or even a quarter as much, depending on how much they increase their copper production. But that is somewhat based off of other information that they have in some of these slides as well. Here's a listing of their own reserves and how it's changed over time. They have 69 million ounces of gold reserves currently, or at the end of 2021, with 12 billion pounds of copper reserves. So very, very significant. So getting into some of the other prep work that we often cover before getting into the numbers, the segmentation. The segmentation I do have split off between essentially their gold and their copper, as well as the other category, which is really just put into the general market category. But it is approximately 90% gold mining, as well as about 8% of copper, with 2% being the other. It does give them a very, very heavy unlevered beta with the methodology I use, because I use basically a company specific type of risk for my unlevered beta. So the overall volatility of precious metals mining companies is very, very high. So even though the beta of gold itself is usually very low and often negative, in fact, that's not representative of the actual risk, because the volatility of a specific company doesn't give us much information. The volatility of many companies averaged together gives us the law of large numbers, which averages out some of the company oddity specifics of their volatility and gets us a more industry-based volatility measure, which I think is more representative of their risk. So there's a lot of risk in gold miners because they do tend to move up and down with the gold price, and so that's why that's here. So I feel that's necessary to give that explanation, because my unlevered beta, as a result of using that methodology, is 2.11 for gold. So we're going to end up with a very, very large cost of equity as a result of that. It is worth noting that that's why it's important that they delevered, because this is an unlevered beta. So it would have been made even worse if they had a whole bunch of leverage. It's going to be basically hardly affected because they have so little leverage. Now, they do have a sales capital ratio of 0.64 for the industry, though I'm pretty sure gold is a little bit low on that end, and adjusted net margins of 26%. So not very great sales capital ratio. That means that they do have to put a lot of capital in place in order to generate sales, which makes sense. They're a mining company. There's a lot of capital expenditure that goes into mining. But they do generate pretty high returns when years are good. This is the average net adjusted margin from last year. It's worth noting. So anyway, getting into the geography specific disaggregation of risk, we have it set up. Another thing that we do specific for mining and resource-based companies is that instead of basing it where the revenues are, since they sell gold into a global market where it's with a global price, it doesn't matter where they sell the revenues to. Any other company, any other country will pick up those revenues at approximately the same price, so it doesn't really make that big of a difference. The thing that matters is where the gold is. So this is where the reserves are, or at least their non-current assets by nation, and that gets us to an equity risk premium of 7.66 because of the pretty risky geographies in which they operate. So putting all that together, after adjusting for our current equity risk premium updated ratio based off of the current dated equity risk premium, we come up to 9.27 for their equity risk premium with an unlevered beta of 2.11. And then, of course, that's on top of the current risk-free rate of 2.15 or so. So our cost of equity, once we do all the other calculations involving tax rates and stuff, is probably going to be very high. I just feel like I wanted to belabor that point for this particular company, because that's probably going to have a very significant effect on the value. They are going to generate tons of cash flow, and our fundamental projections for them are likely to be very rosy. However, the way in which we're going to discount them may make their value, that may take a lot of the value off. They've been in my portfolio for several years. In my last year, my cost of equity that I had for them was 17.9%. So I was already approximately 18% required rate of return using for the discounting for my last valuation. But I have a feeling they might even top 20% this year. Now, getting into the debt, as I show right here, they have $5.1 billion in debt or so, and they have approximately $5.1 or so billion in cash, which is why they're approximately net debt 0. But because of the way we use cost of equity, we're going to assume that that cash is moving through the business, so it's going to have an effect. They do have a weighted average interest rate of 5.95 and a weighted average maturity for this debt of 17 years. They did extend the maturity by 1 year over the last year, so they did do a little bit of work on their debt as far as that goes. However, the interest rate also moved up a little bit, so unfortunately they did have to raise their interest rates in accordance with the overall cost of debts moving up over the last year. So with that, I'm going to get into calculating the numbers, which is going to definitely take some time. As normal, I've already done 1 year of the numbers, but we have 9 more to go, and I will play the fourth quarter earnings call, or at least sections of it, while I work.
Ladies and gentlemen, thank you for standing by. This is the conference operator. Welcome to the Barrick 2021 fourth quarter and year-end results conference call. During the presentation, all participants are in a listen-only mode. Following the presentation, we will conduct a question and answer session. At that time, if you have a question, please press star followed by 1 on your telephone keypad. At any time during the conference, should you need assistance from the operator, please press star then 0. As a reminder, this conference call is being recorded, and a replay will be available on Barrick's website later today, February 16th, 2022. I would now like to turn the conference over to Mark Bristow, Chief Executive Officer. Please go ahead, sir.
Thank you very much, and very good morning to everyone, and good afternoon to those on the other side. And again, welcome to Barrick's Quarter 4 and year-end results presentation. It's been 3 years now since we started on this journey, and Barrick is clearly achieving its goal of industry-leading value creation and sustainable profitability, as I'm sure you will agree with me when you review our results for 2021. By any measure you apply, returns to shareholders, strength of balance sheet, peerless assets, prospect pipeline, a long record of exploration success, and delivery on our commitments, Barrick is a leader in the sector. And the fact that our share price does not reflect this makes Barrick's case for investment even more compelling. Please take note of this cautionary statement, which is also available on the Barrick website. So let's start by looking at last year's highlights, and you couldn't possibly get a better set of KPIs. We delivered on our production guidance for the 3rd year in a row. Nevada Gold Mines confirmed that it is indisputably the world's #1 gold complex and achieved a quarterly production record for Quarter 4. Copper's contribution to the bottom line is increasing. All our operational sites maintained or achieved their ISO health and safety and environmental accreditations. We more than replaced our reserves net of depletion at a better grade. Our wealth of advanced exploration targets will support this replenishment and consequently our business plans well into the future. And finally, we generated significant cash flow and materially increased returns to shareholders. The operating results reflect a good all-round performance, including meeting production guidance for the 3rd year in a row, notwithstanding some considerable headwinds during the year. And the financial results also show we did well against the leading and lagging indicators. Free cash flow for the quarter grew again, and despite cash returns of $1.4 billion to shareholders, we were net cash positive for the second year in a row.
Yeah, and they've got a solution for that.
At the same time, we delivered strong per share growth, with adjusted earnings for the quarter increasing by 46% versus quarter 3.
We'll definitely get into their capital return plan later. Don't want to talk about it until I know what kind of capital they got to return, really.
Report, which tracks our journey.
Like I said, the increase in their cost of equity has me worried.
We're particularly proud of our continued campaign against COVID.
I'm hoping their increase in value can overcome it.
Of our employees are now fully vaccinated, well above the average of the general populations in our host states and countries. We've also seen a meaningful decrease in our total recordable injury frequency rate year on year, which is pleasing. Sadly, however, a tragic fatality in January has set us back, and we are re-engaging with all our workforce to realize our goals in this regard and to reinforce the importance of that journey to zero harm. We'll start, as normal, the operational overview in North America, where Nevada Gold Mines is Barrick's real value foundation. We're building our presence there from this strong base, and we're looking at green and brownfields opportunities across the United States, where Donlin is a particularly interesting prospect, as well, of course, as in our home country, Canada. Nevada Gold Mines delivered a stellar performance crowned by a production record in quarter 4, as well as a strong free cash flow of more than $2.3 billion for the year. This was driven by the 3 Tier 1 mines, Carlin, Cortez, and Turquoise Ridge. And in the face of some operational challenges, proving again that assets of this size and quality can handle whatever you throw at them. The exploration team delivered real value for Nevada Gold Mines and increased reserves by 9.4 million ounces. Measured and indicated resources were increased by 7.4 million ounces, and inferred resources by 5.3 million ounces. And this is after disposals and acquisitions and before depletion. The additional reserves came from Gold Rush, Turquoise Ridge, and Leeville. And importantly, the resource growth came from Carlin and Turquoise Ridge. And so as we build this, our geology and mineral resource management, we're managing the replacement of the gold that we mine, an important component in long-term sustainable mining business. There's still more to come from Gold Rush in the short term, and longer-term prospects for the continued expansion of the complex asset base are very good. As we all know, the environment in Latin America has become quite dynamic. And while we still have some legacy issues there, we are getting on the front foot in dealing with them. We've put a lot of effort into strengthening our presence, transforming Valadera, and sending our exploration teams along the Andes, across the full length of Argentina and Peru, and into Guyana and Suriname to hunt for new opportunities. Negotiations around Porgera have progressed to the point where we envisage restarting the mine in July, but we have excluded production from our guidance for the time being and until we have everything agreed with the PNG government. We've also set up a new Asia-Pacific team to broaden our horizons in this enlarged region, which we see as having significant growth potential. The Tier 1 Pueblo Viejo mine in the Dominican Republic was one of our star performers, achieving a record mill throughput for the third year in succession. Production and costs were in line with guidance for the year. The plant expansion and mine life extension project continues to make good progress, although, as we previously flagged, supply chain disruptions have delayed the timing of the project completion from July to the end of this year. Consequently, we have updated our 2022 production and capital guidance to take this into account. In conjunction with the government, the selection and permitting process for the new tailings storage facility is underway. And once completed, and this is important, the project will deliver a super mine capable of producing more than 800,000 ounces of gold per year up to and beyond 2040. And in fact, most of that period, it's above 900,000 ounces a year, and we have 2 years where we go over 1 million ounces. The transformation of Veladero in Argentina has probably been our biggest success in the region, where we have turned it from a struggler into a significant contributor, with production forecast at around 460,000 ounces for this year. The Phase 6 heap leach facility was commissioned in 2021, and the first stage of Phase 7 is scheduled for completion middle of this year. The cross-border connection to the Chilean power grid was also completed last year, and it'll be switched on when we get that final permit from the Argentinian government. This connection will not only cut Valadero's costs, but will be another important component of the group's clean energy drive. Over now to Africa and the Middle East, which for the third year in a row achieved the top end of production guidance. It also kept up its record of reserve replenishment, replacing 165% of the ounces depleted by mining on a 100% basis.
Does that not change? What the hell?
During the year, the region paid out just under $1 billion in dividends to its stakeholders. And at Loulo-Gounkoto in Mali, production and costs were comfortably within the guidance ranges, demonstrating the value and stability of Tier 1 assets. The complex continues to forecast a robust 5-year production plan, and brownfields exploration across the 2 permits continues to show upside. Across the border in Senegal, we've doubled our land position and continue to generate robust results from the Bambadji joint venture. Kibali also delivered a pleasing performance, with all metrics within the guidance ranges and mineral reserves net of depletion increased for the 3rd successive year at this operation as well. The mine paid $200 million in dividends last year, this being the first step in a process of repatriating the cash to joint venture shareholders from the DRC. Like Lulo and Loulo-Gounkoto, Kibali continued to find new ore bodies within the main mining area, all accessible from the existing infrastructure, with multiple opportunities identified to add reserves in the future, as highlighted in this slide. And in Tanzania, the two previously moribund mines we took over from Acacia have been transformed beyond recognition. Last year, producing in excess of 500,000 ounces of gold together. North Mara is on track to become a new, fully integrated open pit and underground operation this year, and has the foundation for a 10-year plan with plenty of opportunities to expand on it. The ramp-up of Bulyanhulu's mining and processing operations has been completed, and the mine is set to produce well in excess of 200,000 ounces per annum for at least 20 more years. Our copper operations remain a key differentiator and continue to make a real contribution to the group's bottom line. In quarter 4, this business produced 126 million pounds of copper and generated an all-in sustaining cost margin of around $200 million. Lumwana in Zambia is a long-life mine which will be profitable at any realistically conceivable copper price. In Saudi Arabia, we're looking at expanding our presence along with Ma'aden, our joint venture partners at Jabal Sayid. On our own account, we're also investigating opportunities within the Nubian Shield in Egypt. And at Zaldívar in Chile, we achieved a production guidance and completed the chloride leach project, which is scheduled for commissioning this quarter. Each of Barrick's global network of mines continue to invest in their social license to operate, which we work hard to maintain. Unlike Wall Street, we at Barrick didn't discover ESG just a few years ago. Sustainability is at the very heart of our business, and it's not a virtue signaling exercise. Of course, caring about the people and the environments impacted by our operations is a moral imperative, but it also makes good commercial sense, as Barrick's partnership philosophy has proved time and again. This year, we'll again be publishing a detailed sustainability report, which, among other things, objectively rates our performance against all critical ESG metrics. We also remain in the 95th percentile of the Dow Jones Sustainability World Index, and in the top 5% for environmental policy and management, mineral waste management, closure, and social impact. We've also improved our CDP rating from a C to a B, and we will be one of the first in the industry to start reporting on forestry. One example of Barrick's sustainability commitment in action is our mine closure policy, which is designed to leave behind healthy, thriving communities when we end mining operations. We reclaim as we go along, last year restoring more than 700 hectares to their former state. Well-planned mine closure can even be a source of economic benefit. For example, the production of sulfide concentrate at the Golden Sunlight mine, which was closed in 2019, not only removes a potential source of environmental contamination, but provides Nevada Gold Mines with sulfur fuel and pays for the rehabilitation of this mine. An important component of our sustainability strategy is close alignment with our host communities. A notable instance of this partnership philosophy in action is how we turned the tailings mess we inherited at North Mara into a facility that meets international standards and is acceptable to the authorities and the communities surrounding there. Sustainability is all about the future, whether it's our ESG commitments or ensuring we are sustainably profitable and invest properly in that future by consistently expanding our asset base. We published our annual reserve and resource declaration last week. Attributable, proven, and probable gold reserves and resources both grew net of depletion and at higher grades, and while copper showed a slight reduction, there are many opportunities already identified to reverse this. In both cases, upgraded geological models are supporting the group's rolling 10-year business plans. These plans are also underpinned by our strong balance sheet. Prior to announcing the merger with Randgold in 2018, Barrick had a net debt burden greater than $4 billion. Since then, we have generated significant free cash flow and divested non-core assets. As at the end of 2021, in addition to being in a net cash position, we have also returned almost $2.5 billion in cash to shareholders over the past 3 years. We also have a strong record of growing shareholder returns over the past 5 years, as shown in this slide. With this Q4 dividend, we are extending this track record and increasing the base payout to 10 cents per share, up 11 cents from Q3. To enable shareholders
there's
to
4 years.
anticipate future returns,
One more year and we'll do a 5-year trend
the board
discussion.
has approved a performance-based dividend policy tied to the net cash available at the end of each quarter, as shown in the table at the bottom of the slide.
Yeah, what he's talking about, I'm really excited
And
about
at
that.
the same time, the board has also approved
I wish more
a
companies
$1
would do
billion
stuff like
share
that.
buyback program.
They're going to be tying their future dividends to how much cash they have on hand beyond a specific point.
As you can see
I wish all companies did
from
that.
this slide, we expect our free cash flow from operating mines to increase over the next 5 years, no matter what commodity price one assumes. It's worth noting that for every $100 per ounce increase in the gold price, the attributable free cash flow generated by our gold operations increases by around $1.5 billion, thanks to the operating leverage provided by our 6 Tier 1 assets. Similarly, for copper, for every 50-cent per pound increase, the attributable free cash flow increases by around $800 million. This is our 5-year gold production forecast based on a gold price of $1,700 per ounce, and it incorporates the cost impact of royalties at higher forecast gold prices. Our declining capital investment and all-in sustaining costs should ensure a growing free cash flow at any reasonable foreseeable gold price. The same is true of copper, which is already contributing some 20% of our bottom line and is well set to improve on that. In particular, our investment this year and in 2023 at Lumwana for stripping and new mining equipment sets the stage for some significant production growth at this asset from 2024 onwards. And this is our 10-year gold production forecast. It's important to note that this is entirely based on our current operations and does not take into account the many real growth opportunities that are within our reach, including Porgera, Donlin, Nevada, our South American and African portfolios, and the prospects consistently being uncovered by our exploration teams in and around our existing regions, as well as our new frontiers. And so, ladies and gentlemen, getting back to our value-creating story that I started the presentation with, I believe Barrick offers the market a uniquely attractive investment opportunity. We have what is undoubtedly the best asset base in the business, with 6 Tier 1 mines and more waiting in the wings. All our mines have a 10-year business plan based not on wishful thinking, but on geological understanding, proper engineering, and commercial reality. We have a significant and growing copper business, which is already providing meaningful free cash flow to the group. In an industry running out of raw material, we keep expanding our reserves. Our strong balance sheet will fund our investment in growth projects. We have a long record of exploration success and a high-quality target pipeline. Sustainability, as I said in the presentation, has long been a strategic business priority, and we have an industry-leading approach which is entrenched in Barrick's DNA, informing every decision we make. Compliance with standards, of course, remains important. However, it is now a natural byproduct of our strategy rather than the primary output of the team. And finally, we have delivered on our commitment in growing shareholder returns and have now established a clear framework on how this will evolve going forward.
Everybody clap.
So again, ladies and gentlemen, thank you for your attention. And before I pass it back to the operator to take questions, I would also like to take this opportunity to introduce Christine Keener, who's our new Chief Operating Officer for North America. As you know, Catherine Raw left us at the end of last year. We're delighted to have Christine join our team. She has actually recently been with myself and the team out at Nevada.
Okay, so now we have our 5 years. We'll go ahead and do a 5-year trend discussion. doing a few things here. So taking a look at the sales to capital ratio, you can see that here in 2017, 2018, they had sales to capital ratio of 0.51 to 0.54. The reason why I talk about 2017, 2018 in particular is because this is when it was just Barrick before they had actually done the acquisition of Randgold. Now, after that in 2019, it dipped down pretty significantly as they took on a very significant amount of capital base, and they hadn't quite gotten as much revenues for it immediately out the gate. Then we go into 2020, and after through 2019, gold prices had risen up. It usually takes about a year for these prices to work their way into the revenues because of futures contracts. So by 2020, they were starting to actually feel those revenues, and you can see it shooting up from 0.29 to 0.38. Then you can see here in 2021, it actually dipped down to 0.36. That comes on the back of them making a lot of capital investments during the end of 2020 and into 2021, relative to the not really any movement in revenues in 2021 on average relative to 2020, which we'll get into. So basically, it's a little bit of a lag effect that you can see on that, but they're slowly but surely kind of trying to ebb their way upward towards this number at least. And then we're going to take a few other things into account, which is sort of what I was doing on this little side number thing over here, where I've actually taken into account their total inventories, not just their current inventories, but also their non-current inventories, which tells their total gold stockpile, and then dividing that by their average capital expenditures over the course of 5 years. I wanted to use their net capex, but unfortunately they've been doing lots of depreciation and impairment, so it comes out to a negative number. So I'm using the regular capex because it's the only positive number I can work with. But either way, if I divide that by their positive number, that gets us 3.69, which basically implies that if they did zero capital expenditure, they'd have enough gold to effectively sell off as though they did capital expenditure for like 3.5 years, which basically means that even if they just lower their inventories, they can essentially get much more sales relative to their capital expenditures based on that just alone. So we're going to target towards this number, but also giving them the benefit of the doubt in a large way for essentially up to 3.5 years worth of the numbers. Probably not all 3.5 of it, but probably like half of that maybe. So think of it like up to 4, then maybe about 2 years worth of essentially benefit of the doubt when it comes to the capital expenditure, which is going to be important because of their low sales capital ratio. We need to give them that benefit of the doubt. Otherwise, it's going to make it look like the large growth in revenues they get just from gold prices going up is going to cost them a lot of money, when that wouldn't really be fair for them. So it's just something I was going to point out, where it's a surprise tool that'll help us later. So getting into their cash flows though, you can see that they've had pretty strong returns on equity prior to doing the deal, but that comes off the back of a relatively negative shareholders equity and return in the retained earnings part. As you can see here, they've massively increased their retained earnings, that has made it less negative, and I cut it in half through this year right here. And that comes off of the back of these non-controlling interests, which you can see took off after they made the acquisition as well. So yes, they have a decent amount of retained earnings that has changed over, but it's essentially switched over to non-controlling interests, which comes from the subsidiaries that Randgold had and the deals that they had to make with them in order to keep those contracts. So I do see this retained earnings is not a problem, because you can see that they actually have a path to clear it out. And this is while they're returning a massive amount of capital to their shareholders, which they were talking about. The returns on invested capital, however, are a little bit more chaotic. It's definitely not very pretty. We're probably going to look at 5 or 9 year averages in order to get an idea of what the business is like because of the chaos of it. But if you do look at that, you can see that it does make sense. 8.43%, pretty decent return on invested capital, if it wasn't for the fact that their cost of capital is extraordinarily high. And then it's not that great of a cost of capital, but it would be at least meeting the cost of capital for most businesses if it wasn't a mining business in particular, which is the problem. And you can see they have a return on equity that's actually lower than that, which comes off the back of that negative return to any earnings. So it shows that over the history of these 5 years, the equity actually hasn't been able to get as much of a return as the capital investor on general has. Maybe the 9-year average will improve that scenario for them. Speaking of which, I did want to take a look at the 5-year average for the sales capital ratio, which goes from 0.34 to 0.42. So that gives us maybe a little bit of an increasement of where its current base is, which could come off the back of them decreasing their capital base and increasing sales in the forward year. So I think that's probably a good base point. We will take a look at that 9-year average once we have it though. So moving further up the line, You can see that their credit net margin also a little bit more chaotic, though at least chaotic in a lot of largely positive way. We'll switch that over to the 5-year average as well, going from 27.5 to 17.5. So that large negative effect does have a little effect there, but that gets us a little bit closer to the current year average, which could take inflationary effects into account. We'll take a look at what we want to do once we have all 9 of the numbers. We might use a more recent number or a longer range average, depending on how things work out. This tax rate, though, is roughly in line with what we probably want them to be. Is going to be a roughly high tax rate, which comes off the back of the foreign business that they have to do, though that does give them a benefit for their cost of debt and overall cost of capital as well. And then the interest rate, we'll also take a look at what kind of average we want to do for that on the net of it as well. But looking over the revenues, we can take a look at the overall 10-year period of the revenues, because I have already put those numbers in, so I could look at the commodity price correlation stuff in some of the prep work. But so taking a look at that, you can see that they had obviously a pretty solid decline for 5 years in revenues, which came off the back of the huge drop in the gold price down to the bottom levels, which their revenues bottomed out in 2018 at $7.2 billion, but that's the same year that they made their acquisition. So obviously they got a huge bump in revenues just on the back of the acquisition in the following year, 34% increase in fact. And then you can say 2020, the increase comes off the back of the gold price through those 2 years as well. So they basically got to get their revenues roughly up to where they were in 2013 to 2014 on average or so over the course of this period. And then they had a little bit of a dip in 2021, probably coming off the back of having to make rearrangements with certain pricing metrics, as well as the gold price did drop and then moved back up. It on average stayed about the same, but it did have some volatility in it. So that probably affected some of their ability to trade on net of that. Though obviously they were able to manage the costs of revenues throughout that pretty significantly. So with that pretty lengthy discussion of just the 5 years, I'll get back into the numbers now and continue playing the call. It sounded like they were going to get into the questions here shortly.
She's in the saddle, and Christine, we welcome you to the team, and I'm sure many of you will, in short shrift, have time to discuss matters with Christine going forward. So with that, thank you for your attention, and again, the greater Barrick team, some of them are here with me in Toronto, are online where they are not in Toronto, and we'll be delighted to take questions should you have any.
Thank you. We will now begin the question and answer session. To join the question queue, you may press star then 1 on your telephone keypad. You will hear a tone acknowledging your request. If you're using a speakerphone, please pick up your handset before pressing any keys. To withdraw your question, you may press star then 2. We will pause for a moment as callers join the queue. Our first question is from Cleve Rueckert with UBS. Please go ahead.
Great, thanks for taking my question, and congratulations on finalizing the dividend policy and a good set of results, Mark and team. I've got 2 questions. The first, Mark, just on the 10-year outlook on slide 28, I appreciate you gave just a synopsis of a couple of the areas that could add to that forecast. Aside from Porgera, I don't know if you could give us a little bit more color on potential growth opportunities before that 2027 time frame that's laid out there in the slide. Where if you have any confidence on adding to that outlook kind of in the near term.
Yes, so of course in the near term we've got some opportunities, some real opportunities, and you've touched on Porgera already. In Nevada, again, we've got some very exciting new targets, both adjacent to known infrastructure and projects that we have initiated, like looking at the gap between Twin Creeks and Turquoise Ridge. And we've got some more new greenfields exploration across the Nevada complex. We are looking to grow our opportunities in DRC at the moment. We have got some very interesting opportunities that we are evaluating. As I touched on, we've got some exciting exploration ground in Senegal, across the river from Loulo-Gounkoto. We are continuing to work on the portfolio of projects that we have along the Andean trend. And again, our big focus is adding life to Veladero. And Veladero in itself is part of the Pascua-Lama infrastructure. And again, as I've said in previous presentations, we are working really hard at trying to define the resource base, particularly in the Lama side of the Pascua-Lama project, which is in the Argentinian side. And we have a target of 2024 to try and get our head around the prospectivity of those many targets that we inherited from the previous Barrick management. And then of course there's the challenge of realizing the arbitration award that we received in favor of the Reko Diq project in Pakistan, and that's something that, you know, is a key component. It's something that's not reflected on in our share price. And at the same time, we've opened up new frontiers, as I touched on. Egypt, we're busy working there. We are looking at expanding our partnership with Ma'aden in Saudi Arabia. We've got geologists now working in Guyana in South America and also Ecuador. So again, we've pushed out the boat. I think the key for me to leave with you is when you look forward, you know, we really get easily up to that 4.8 million ounce a year target, and we build it on really the big tier 1 assets that we have. And I'll give you an example. Carlin will grow. Well, Carlin is a 1.6 million ounce producer, and it goes on for a long time. The key growth in Nevada is Cortez. And on the back of the record of decision we're expecting out of Gold Rush, Cortez moves very quickly into the 900,000 ounce per year and then a million ounce producer for that long 10-year period. So that is a big contributor to Nevada and its contribution to the bottom line of Barrick, and of course Newmont as well. And then Turquoise Ridge has got a steady ramp up forecast for the next 5 years at least, and that takes it up to the sort of 700,000, 690, so 650 to 700,000 ounce production profile. We've got some exciting opportunities in Tanzania. We are very bullish about Tanzania and the opportunities there now that we've got those two big operating platforms. One is Bulyanhulu, which still has capacity in its processing facility. You would have seen that we've announced the expansion of the Bulyanhulu footprint just recently. And the challenge in Bully is we need another mining front, another set of faces to operate, and that to do that.
Sorry about that. I mean, it's kind of surprised me and arrived.
Vein system, which is the primary sort of ore body that we mine currently in two different ore bodies within the Bulyanhulu mining lease. Same with North Mara. We've now got North Mara properly balanced, a decent 10-year plan made up of an integrated open pit and underground mining structure. And you would remember North Mara was one of those mines that was either roast duck or no dinner. And what we've got now is a very consistent 300,000 ounce production profile for 10 years and a lot of upside that is not baked into our plans yet. And then Mark and his team are starting up our Asia Pacific focus, and you know we're excited about the opportunities to grow a footprint in that area. And again, South America is, as you all know, is a challenging a place right now to operate. But with it, as I've found in my career, that always brings opportunity. So we have a great team. We are expanding and improving our exploration groups, both in South America and across Africa. And we've built a very solid exploration team in North America. That's both Canada and the United States. So, you know, there's lots to come organically. Of course, as you know, one big discovery changes everything. And that's where you really create value in a mining company.
Right. Okay. Thank you very much for that color, Mark. And you know, sort of switching gears a little bit, you know, thinking more about capital allocation. You know, I know you like to talk about M&A. You're sort of always assessing M&A. It seems like, you know, the deal, you know, or at least the competition for deals has been, you know, somewhat intense over the last couple of years. You know, I guess this presentation really focused a lot more on the organic growth opportunities, and now you're sort of reinforcing the buyback and the dividend. Has your thought process around M&A changed at all in the last couple of months or the last year?
Not at all. And as you know, I talk a lot about M&A and have done very little. But the M&A that we've done has been value creating, you know, and indisputably value creating. And I think I would point out the competition for M&A at the moment is a competition to survive. And so, you know, you get these very high-priced deals, and we don't do deals like that. So people know that. We've been around, as you know, you've known me for a long time, and some of the audience are even longer. And so, you know, we've got a very strict filter now in the way we assess opportunities, and you know, I think you know, we were going reasonably well. I think ourselves with our deals and the acquisition by Newmont of Goldcorp created real value for this industry. You know, I reflect on some of the recent transactions, sort of brings back memories of 2012 and 2013, and you know, we're not in that business, and we don't have to do those sort of transactions. We don't have to.
Hold on 1 second. My catch got locked out again.
We've got a solid platform, the same as we had in Randgold Resources, and our intention is to build on that value platform that we've created. And we set out to do that. You know, in 2018, when we announced the merger with Randgold, we were very clear that our focus was high-quality assets run by the best people, focus on profitability and real sustainable returns to our
Sorry about that.
And that's what we intend to continue to drive at.
Cheers. Thank you very much, Mark. I appreciate it.
Pleasure.
Our next question is from Josh Wolfson with RBC Capital Markets. Please go ahead.
Thank you very much. So understandably, strategies and philosophies change over time and adapt to the market. You know, historically, for Randgold and Barrick, share buybacks have not been one of the primary factors for capital allocation. You know, as part of the new strategy, it is something which is more prominent. Mark, could you perhaps walk us through you know, what's changed and why this is the right move?
So, Josh, for as long as I've known you, you've been trying to change my strategy. That strategy's been pretty focused and clear, and at the same time, we react to certain situations, and one of them is that we feel that the share price is not being properly valued, and so it makes sense to clear the opportunity, clear it with the market, the opportunity to buy back stock in a situation like this. So I don't understand how you can say that's a change in strategy. I mean, it makes sense. It's a provisional approval. We can do with it, we can use it for the right reasons. And we've been very clear about that. At the same time, we are very focused. As I promised you and the rest of the crew 3 years ago, we have delivered a revised
sorry, my cat's being a pain in the ass.
On the strength of our P&L, and that's always been the strategy. I don't believe in creating dividends or borrowing to pay dividends. I've always paid dividends based on the strength of the P&L, and to be able to have a strong P&L, you have to have quality assets. And so, and you need to clear up your balance sheet and your debt structure, which we've done. So everything is, ticking the boxes. And 18th of 2018 September, we very clearly said that's what we're going to do. Take out the debt, clean up the balance sheet, focus on high quality assets, and returns, real value creation on a sustainable basis for our shareholders and other stakeholders as well.
All right, I'll do my best to try to refrain from changing the company strategy, but don't hold me to it. On the new sort of 5-year outlook, looking at the production, it looks, and granted, we're working with our geometry sets here, it looks a touch lighter in, maybe 100,000 ounces over the next couple of years. What would that be attributable to? Is that a function of PV, or are there other factors in there?
So there's this year there's a change in the balance because of the expansion in Pueblo Viejo, which we've communicated some time back, and that drops the production by 100,000 ounces. It builds back up immediately next year as we finish the completion of the expansion. And the background behind that. The growth side, so going from 4.4 to 4.8 is very clear. There's the other change has been the suspension of operations at Long Canyon. And
there
again,
we go.
For that asset, we're
sorry, I had to correct a mistake there a little bit.
Our portfolio or not, because again, we're very focused on the quality of our assets and the longevity of the assets. And the other one is will be Hemlo, where we've reset the ramp up. And so we've slowed that profile as we wrestle with getting that mine back on track. And that mine went through some challenges with COVID, and we made a commitment to bring in contract miners, and then COVID blocked, shut down the ability for the Australian teams to come into Canada, and so we're reassessing that operation. And those are the impacts on that profile, but the profile still, is I don't know what sort of accuracy your ruler is, but it takes us back up to about the 4.8 billion ounces. And remember, these are ounces and plans that we have cleared. They're not forecasts. They're actually plans. Josh?
Understood. Thank you.
Our next question is from Matthew Murphy with Barclays. Please go ahead.
Hi. Similar question on the charts, guidance outlook on CapEx, though, this time. The way I'm looking at it, it looks like CapEx is up around 200 to 300 million bucks a year. Do you disagree with that? And if it is up, what are some of the drivers there?
So, just for capital's sake, one of the biggest drivers on capital is the decision the whole focus on Lumwana. The fact that the African and Middle East team got their head around Lumwana, got the cost down, they halved the mining costs. There's a bigger investment now in investing in the equipment. We've got some additions to make to like the crushing circuit and so on. That's a big change. The capital in Porgera, in ramping up Porgera, that's not in the forecast, Graham, yet, the capital for Porgera. So then it's, so I'll pass it on to Graham. He can finish the explanations.
So, thanks, Matt. I mean, the key drivers, as Mark has already touched on, is some of the changes in the mine plans. We've obviously had some carryover of capital from 2021 into 2022 and a little bit beyond, related to the delays in the PV expansion. That was
Right, only 2 years ago. Then we can get into the fun stuff.
Over a little into 2022 because of the global supply chain constraints that we've had there. The other area where we are investing more is in the copper business in Lumwana, where historically that's a business that has been a little starved of capital, and we're really investing in that business because we see a lot of growth opportunities, and you can see that in the profile of the Lumwana ramp up over the next 5 years, where we've got new fleet and other initiatives that'll increase our availabilities. So that's a big factor coming through as well.
And Matthew, the most important thing is next year is our last big capital year, and then it starts coming down, and that's the driver. When you look at Barrick in its 5-year plan, and all you need to do at the end of the 5 years is continue those graphs for the 10-year plan. What you do see is a growth in cash flow, free cash flow, because of that declining all-in sustaining cost. And so, whatever gold price you run the model at, you get an increasing cash flow in the 10-year plan. And
True.
That's, a lot of people say, this is a flat production profile. Yes, but it's long, and it's exploiting a capital base that we will have completely invested in by the end of next year, early the following year, and then you get the benefits of that over a long period. Grant?
The only other points I was just going to make was just in the AME region, where we have got a little more capital in Tanzania, which is related to the redevelopment of those plants that Mark's already talked about. So the ability for us to be able to ramp up that production following the completion of the feasibility study at Bully, as well as the mine redesign at North Mara, where we've now got both the open pit and underground coming back into the plan. So there's a little more capital in there. And then at Lulo, where we've got the expansion to our solar plant. So that's all linked into our GHG reduction plans, where we're investing in solar capacity.
And
the expansion.
The extra 200 megawatts in Nevada as well. And I would just point out, Matthew, those our program, our path to 30% reduction that we've detailed, all those projects are delivering 15% IRRs at $1,200 long-term gold price. So they all, as much as they knew, and they're dealing with our greenhouse gas emission commitments, they do reduce the costs and deliver real returns as a business, as an investment.
Hey, Mark, is that with a carbon price, or is that just, business as usual doing the project?
That's just business as usual. And, one of the things we stuck with is we didn't get caught up in this rental stuff. We waited until the solar technology and market was as such that you could own your own solar cells and install and derive the full benefit of solar energy. And again, Barrick, with the experience we've developed in Africa as well, is that we've grown our knowledge and understanding of microgrids and power generation, and that roadmap to 30% reduction is a real engineered, modeled, project processed investment. It's not a promise without a plan. It is the plan to support the promise.
That's great to see. Thank you.
Pleasure.
Our next question is from Jatinder Goel with BNP Paribas. Please go ahead.
Thanks, operator. Good afternoon and good morning. Couple of questions. One on dividend policy. It's good to see aligning it almost to Rand Gold days and basing it on net cash. But just to understand, is there a maximum net cash balance that you want to keep in balance sheet and pay everything beyond that away, or is $1 the maximum dividend that Barrick will pay in any given year, and maybe any excess gets funneled through buybacks if the share price allows that?
So,
Right, just one more here to go.
Here is that we want to grow this business. You know, we set out when we did the deal with
Oh, Jesus. I'm
we
going
want
to
to
here.
build a real business,
Lord
a
have mercy.
business that's relevant in the public markets. And so part of that is building a stronger, ever stronger balance sheet. At the same time, we want to have that commitment to our shareholders, where you can, you know, look at our plans and expect and know what sort of yield you'll get from the payout. So right now we stop at it's $1 billion, $1 billion to $1.5 billion, and that payout. So that payout keeps going. Not to say that we wouldn't revise it, but that's a good start.
Yeah, I think
we got to get to the $1.5 billion net cash first.
Look, I think the point is it's a self-correcting formula. So every quarter we look at where the cash is and we pay out accordingly. So to the extent that, you know, we don't pay out cash this quarter, that cash is available for a performance dividend next quarter. So you know, that's how the formula works effectively. So provided we're net cash, we are looking to pay a performance dividend.
Okay, thank you. Just one on Porgera. It looks very ripe for an imminent restart. I understand why you would exclude it from the guidance, but are you able to provide any more color on the possible
Let's screw up here.
restart, and how long will it take to get back to full capacity? Thank you.
So just let me explain to you where we are. So we signed a framework agreement, was binding. We now
49.
recently signed the
Okay, there we go.
commencement. So the
All right, now the final
project
cash flow.
commencement agreement, PPCA, and that sets the takes the framework agreement and enhances that agreement, gives us more surety on the investments we're going to make. It clarifies the rights of the various shareholders and opens the way for the incorporation of a new Porgera vehicle company. And to do that, of course, we need
Just
a
realized I screwed this part up for the last year at least. Hold on.
Company constitutional.
I have to
And
correct
so,
for this.
We've now settled the terms
Okay,
of
so
those
yeah,
agreements.
those do that.
We need to get it signed, and that's a step. It's a process.
Okay, that goes all the way through
of the fact
2017. I have to
there are
correct
more
that.
than one stakeholder on the Papua New
I thought
Guinea
there was something
side.
kind of off.
Once we do that, we then have the ability to apply
Okay.
for the SML, the Special Mining License, and roll the exploration licenses
2013.
and other permits from the old Porgera into the new Porgera. That's a process in itself. And then we are, but the
Here.
negotiations, legal process is
these
complete on
two.
that. And then
And
we've
then that
got
one.
To settle the operating
There we go.
agreement.
Okay,
The
so yeah, I might have to
framework
correct
of
these
that
other
is set in the
2 years as
framework
well.
agreement. And
Accidentally
and
included a
the
line
other
that does not
key
belong.
process to be dealt with is the development forum, which is a provision under the
So
G&G
recent
law,
inventories down through the
which-
other operating activities.
whereby
We skip that
various
line.
landowners and other interested groups
And this is
get
going to be
together and under
same
the MRA
at
stewardship
AH.
and allocate to them amongst themselves the equity that's been reserved for.
Yes, I
the
accidentally
landowners.
included this
And
line before,
once that is done,
which is really just a summation
we're
of what's
ready
above, so that
to,
cannot be in there.
commence with the
And then it's in these two as well.
restart. What we have done.
I thought those
in the
cash flows seemed a
interim
little
as
high,
part
but I
of
couldn't
care
figure out what the
maintenance
problem
is
was
we clean
before.
up the pit.
Usually if I just stare at it
Cleaned
long
up
enough,
the
I'll figure it out.
underground, taken all the muck out of there. We've also reviewed and done some servicing on the mobile
There we go.
equipment. We're currently now working through
This is
the
the last
processing
one.
plant just to make sure that everything is operational. So we have done a little bit of operational readiness work ahead of the final,
Okay.
proper
There we go.
restart.
Now we can
And again, the
move on.
restart period will be
Finish the
around
cash flow
6
statement
months,
of the
depending
last
on
year.
exactly when we start the restart and how much interim work we've had completed.
Excellent. Thank you very much, Mark, for the detailed explanation. All the best.
Thank you.
All right, now the financing line.
Question is from Anita Soni with CIBC World Markets. Please go ahead.
Hi, good morning, guys. So most of my questions have been asked and
Not
answered, but I just
include
wanted to
this
get a little bit better understanding on Lumwana and where exactly you're spending the in terms of
Net
sustaining
out
capital and
options.
and growth capital breakout. That would be the first
Check
question.
dividends.
So, Anita, the
All right, now onto the
as
final
I
balance
said,
sheet.
we've got a new fleet. We've bought part of it. It's still coming. We're upgrading the whole fleet. The team, we went in there, we dropped the mining cost by nearly 50%. But, the fleet was an old fleet. So that's one that I know we've still got more fleet to arrive. We've got some upgrades to some of the equipment that we'll keep. And then also there's some work to be done on the crushing circuit as well. So, that really takes us to the sort of, I'm wanting to say 350 million pounds of copper, hey, Graham?
Yes, 100%, but yes.
15 million, I think.
So that's the plan. And then there's an additional point to add not a large amount of money, but significant is some of the exploration we're doing. We've identified some new satellites, and under the current mine plan, 2026-ish, we've got to make a decision on a big super pit pushback. But some of the exploration work we're doing is indicating that we could be able to find some better grades and lower strip ratios that would delay that decision and extend the life. And the current super pit will go for 60 years, and if we can add more lower strip.
All right, now the final equity statement.
We will extend that decision till later.
Wow, look at this. Way back in 2012, they actually had positive retained earnings. Crazy. They're almost back to positive retained earnings, but
fleet upgrades.
It's been a long time coming.
Making sure that we can do all the tons, both the waste tons as well.
Okay,
and
finally finished all 10 years.
The throughput through the plant.
Fantastic.
And
Now we can actually
we at one stage we were going to
get into
sell
some
this
stuff.
asset. We couldn't get we knew the value.
And close out of that call. All right. So, taking a look at the sales capital ratio first, as we typically do. As you can see through the peak of the last gold cycle, which is really the back of those final back years that we have, you can see that their sales capital ratio is roughly in line with sort of where they were today. And then as they really reached those last few peak years, it really extended really high as the capital base wasn't keeping up with the amount of sales that they were getting. And then eventually they made more investments, as we'll get into in the cash flow statement, and then the price fell off. They made large impairments to their assets, which is why the sales capital ratios remained pretty strong after that period. However, then obviously they made their acquisition, which changed things up, which we talked about in the last little 5-year period. So getting into the cash flow statement, as we were sort of saying with the retained earnings, it's been in negative territory ever since they made those large impairments, and then they've made a large improvement of it after making the acquisition with Randgold, and now they're starting to actually make headway in improving it, though it also has increased the amount of dividends that they have to pay to non-controlling interests as a result of that. Liability, as you can see, has come down pretty significantly over the 10-year period, with the assets actually not really changing at all. So that's partially where the pretty significant increase in the total shareholders' equity has come from, even though, as I've said, a large amount of that shareholders' equity is actually gone to the non-controlling interests. So the shareholders' equity to the common shareholder is only barely increased. Moving into the cash flow statement, you can see that the returns on invested capital have been pretty shaky all over the place as a result of the total gold cycle, which is why we were looking at the 5-year average, which still gave us not a very good number. It's at least pretty positive, but it's not positive enough to cover their cost of capital in a large way. If we take a look at the 9-year rolling period, it's probably going to go down. Yeah, it's about flat because of the large impairments that they had in the past. It is more reasonable to think about the 5-year average or even the 3-year average as what makes more sense, since 3-year average would really cover what's like since they've become the new company that they are currently. There's kind of multiple ways to look at it. However, the 3-year average would obviously be latent by the fact that the gold cycle was a little bit more of an upswing at that period. Though whether or not it's at its peaks is hard to say. I'll probably leave it at the 5-year average, since I think that's a better mix between the two. By the way, coming back down to the sales to capital ratio, if we look over the entire cycle for that, I think it'll probably move up a little bit. Yeah, a little bit, but not too much. We'll probably come back to saying the 5-year average for that one. Moving above the returns on invested capital line into the actual cash flow statement itself, you'll see that the total common payout over the entire 10-year period is really not been very much. It's averaged about 1.5 billion per year, and over the entire time frame, the total cash flow that they actually had available to them, or not 1.5 per year, 1.5 billion in total, my bad, partially because of the huge amount of the shares issuance in 2013. So they really have hardly paid their shareholders over the entire 10-year period. The dividends have not been that much. They paid a lot in the most recent year, but that's really actually where a lot of the returns have come from. And then over the entire 10-year period, they could have paid out, I believe it's about 20 billion, 21 billion or so. So they've barely paid their shareholders over the entire 10-year period. Though looking at the 5-year period, I think it probably improves rather significantly. So $19.6 billion in total cash flow in this 5-year period, which basically just goes to show that basically all the cash flow has shown up in this period entirely. And in that time frame, it's been 2.7 billion paid out to shareholders. So yeah, more than double over that entire time frame because of the share issuance in 2013. Looking at the corrected net margin over the entire time period, it's going to be pretty bad because of the impairments as well. Yeah, actually into negative territory. We will probably use the 5-year average as our base year for what we're going to project, because like we were saying, it's relatively close to the most recent year. In fact, it's a little bit lower, which I think is pretty good if you want to take maybe some inflationary cost pressures into account, even though we probably will have the margin expanding over time. 5-year rolling for the interest rate is a little bit higher than we really want it to be. Want to get it more into like the 30s or something. Also, a 3-year average is probably going to make a bit more sense for that. Rolling cost of debt, that's probably okay. We can maybe even just use the most recent year rolling number. The book listed number is like 6% or so, but they do have a little bit higher of a number as a result of paying down their debt a little bit earlier and having excess debt costs as a result of that. So now we've kind of covered the 10-year period. We can start getting into some of the projections we have for things. Definitely don't pay any attention to that because we have to cover all of the projections that we're going to put into things. I already talked about how I'm taking development costs into account. I'm using their exploration costs and amortizing them out over time, and then the amount of time that I amortize them out is based off of the total amount of reserves that they have weighted by gold and copper, which comes out to about 14 years or so, which gives them $2.1 billion in corrected profit in the most recent year, relative to about the $2 billion that they have reported. So it actually, our adjusted profit's a little bit larger for them in the most recent year period as a result. And then we also talked about how we're going to give them a little bit of a boost to our sales to capital ratio expectations for them, because the total inventory is not just their current inventories, but total inventories of ore, $4.3 billion, divided by the amount of capital expenditures that they've had on average for the last 3 years. gets us a suggestion that if they just did no capital expenditures, they would actually have enough gold and ore to sell for over 3 years effectively. So we're going to kind of assume that maybe they wouldn't do that exactly, but they would perhaps maybe do less capital expenditures and thin out their inventories, maybe even half as much of it, maybe 2 years worth or something, which basically suggests that we can give them a larger boost to our sales capital ratio expectations moving forward. But we'll definitely get that after we cover revenue expectations. Taking a look at the debt to equity ratio, you can see that it is about 11 to 12%, which brings the levered beta up to 2.27, which brings their cost of equity up to 23.15%. So yeah, like I was saying, because of the industry we're using and the methodology we're using, the discount is going to be insane, which is why the price is so low currently. But we do have all the other assumptions to adjust for, so definitely no point getting into it on that. Margins are not accurate yet or any of all that stuff. So now we're going to get into my model for their revenue pricings. We're going to talk about gold first. The gold price down here. So I have get all this information from gold.org. It's a public resource that people can get all sorts of information for the global gold market and things and operations related to that. This is global gold mine production over the last 10 years or so. The gold production in tons on the top line right here. And then this line below it is the gold demand that's filled by the mine. So it's not taking into account the amount that's been recycled and all that. There's a little bit of a mix match between these two, which I've taken into account right here, which basically just goes to show how much excess demand there is relative to the amount of gold that was produced in 1 year versus the amount that is being demanded over any one particular year. And then here I have the average price of gold in each of those years. I've used a few interesting little kind of basic, simple trendline regressions to kind of come up with what I think the production levels based off these trends are likely to be in 2022, and what that could suggest about the demand that would exist in 2022, and then how that turns itself into a suggested price for 2022. I come up with these the belief about the price partially off of the change in the above ground stock over that same 10-year period, which is what I have down in this lower section right here. You see that this is what the overall usage of gold is by its category in the overall globe. And then this is the total market for gold, which is basically all these categories, not counting the other categories, since we can't really account for that specifically. So this is what I consider to be the market of gold as a whole, which in and of itself also, this total size of the supply of gold also grows at about 2% per year. So production grows at around 2% per year. The supply of gold grows around 2% per year. We can use these metrics as well as like I said, the overall changeover in the demand for gold to get a suggested price not only for 2022, but then we can project it forward based off of that. So I have for 2023, 2024, 2025, 2026 different gold prices that I think it should be based off of the supply and demand. So with that, I come up to $1,961 for my 2026 suggested gold price based off supply and demand. That has nothing to do with how much money printing that they'll do. We'll get into other things based off of that. Speaking of which, I actually totally didn't even pull the right spreadsheet out for that. I needed to realize that. This is just one of the prices that we're going to cover. For my commodity pricings, usually use a combination for all my valuations. I use 6 different models, and so we need 6 different prices. That one price is going to be our median price. I usually have a sort of a middle base price, which that 1961 is going to be our median price. Now, I also have on my gold spreadsheet over here a variety of other correlations and projections I've done. This is a sort of a model I've shown a few times on the show with different commodities, where I take the supply of money and I take correlations of that based off of the growth of money, where I think the suggested price of various commodities would be based off of different growth rates of the money. So with that, I have a suggested price in 2026 for gold of $2,179 if there is no money printing between now and then. If they double the money printing rate between now and then I have a suggested price of $4,200. On average, between all these rates in the middle, I end up with an average of $3,100, which is a suggested 10% return on gold per year for the next 5 years. So this is just one other methodology to get suggested prices for gold. And with that, I use both the average and the highest number to come up with my next highest rates for gold. So I have both my median case, my relatively high case, and my highest case price for gold. Now I also have to have a methodology for coming up with my lower case targets for gold. With that, I take the 30 years of prices for gold, just the historical ending price for each year of the last 30 years, 30 being a statistically relevant number. Hey, how's it going? Nice to see you in the chat. We take the quartiles, we rate them all by the price, and take the quartiles of gold. And with that, I take the lowest quartile and make that one of my prices. And then I also take the average of all 30 of the historical ending prices of gold, and I make that my not quite as bad but still lower than median price for gold. So with that, I have 5 prices of 5 years from now gold, 2 of them based off of a historical return to trend, 2 of them based off of a monetary based theory of money printing and commodity pricing based off that, and another one of them based off of supply and demand of the gold market itself. So 3 different methods, 5 different outcomes based off of that right here. I also have my analyst price that I'm going to use as well. I went and found 5 or 6 different associations with analyst based prices for expected gold prices, and the best price I could find was one for, I think it's 2023. They had a 2023 suggested price of 1851. So that's the price I'm using for the analysts. So with that, that's my 6 prices of gold. With that, I end up with outputs of revenue of various revenues of anywhere from just under 5 billion in 2026 to 24.6 billion, and this is based off of a 63% correlation between the last 10 years ending revenues and the last 10 years ending price of gold. So there's a pretty strong correlation between the revenues of Barrick Gold Corp and the gold price, which is why I'm using these numbers. It's not one analyst, it's an average of many analysts. It's the average suggested analyst price for 2023 based off of like 5 or 6 different associations of it. I don't try to rely on one specific analyst. I try to get like a statistical average of it. But either way, and it's worth noting that these things kind of come in line with some of the other factors that the Barrick reports for themselves. We're gonna get into some of these details as well. I've looked at their urge deck here. They have their own price assumptions that they include in some of these things. If you look down at the bottom of their thing here, in their call, they themselves are projecting a price of $1,700 for 2022. In 2023, they believe the price is going to be $1,200. But it's worth noting that $1,200 gold price is the same assumption that they've had for the last 3 years. That's their standard assumption. They don't change their assumption based off gold price because they know that the gold prices are all over the place. So I think that's them being particularly conservative. They don't really project their expectations of it. But they also believe that oil prices in 2022 were going to be $65 a barrel, and this is because they released this report at the start of the year. So you can see that like they're usually very, very conservative in their own assumptions for the company themselves. And then this is the chart that they have based off of a range of prices that they themselves provide, the base of it being the 1,200 that they use as their assumption, which just goes to show that even they admit that this is sort of a base assumption of $1,200 an ounce, but also with the $3 per pound for copper on it as well. And with this is what they believe their free cash flows would be between 2022 and 2026, the cumulative amount of it is worth knowing for all of those years. So if they just hit the middle of this, or even the number that I was suggesting that they would hit, which is sort of in this range right here, or the analysts are suggesting they would hit, then that means that they would expect to get about 17, 18 or so billion dollars in free cash flow over the next 5 years. So divide that out and you end up with like $3.5 billion of cash flow per year. So that's free cash flow, not earnings, though they don't have a large amount of debt. So those numbers are not terribly far off as long as depreciation and capital expenditures are relatively equal to each other. Now, we are going to talk about their capital return plan that they've discussed in the call as well, which is really, really interesting. They have a cash balance currently of about $5.3 billion and about $5.1 billion of debt. And they currently have a dividend of 10 cents per share, as well as about $1 billion in share buybacks available for them. the 10 cents per share, it comes out to be like $750 billion in or so in, or $750 million, my bad, in capital return. So that means over the next year they have a suggested $1.75 billion in capital return, but that's not including the performance dividend they have. They are now planning to include a performance dividend every quarter, depending on how much cash balance they have in net cash. So they currently have net cash of, in this level 2 area, of greater than 0 but less than 0.5, which means that they are currently slated to be paying a performance dividend of an extra 5 cents per share, which would mean it'd be 15 cents per share, which means that would be like an extra 375 million or something in capital return. If they build up their balance sheet before doing so, which I think is very likely they do considering the profitability levels they're currently at, then it could end up being double that and turning it into $1.5 billion in dividends, or even turning it into 25 cents per share, which means it would be closer to $2 billion in dividends, and then 1 billion as well in the share buyback. So they've created a new dividend policy that makes it so that their dividend is going to move up and down with the profitability of the company, the cash flow profitability of the company. And I think that's amazing. I wish more companies would do this, have an automatic system based off of what's available to pay out, rather than just paying out some arbitrary specific amount or increasing it to stay on the dividend aristocrat list or whatever. Like, you know, high dividends are great, but dividends that are reasonable, sustainable, and appropriate are even better. So I think that this is a pretty cool plan that they have in place. So anyway, we're going to get into some of the other projections as well that we talked about. They have they talk about their own capital expenditure plans of 1.9 billion to 2.2 billion in this next year. They actually provide quite a lot of guidance, but it's mostly just like production guidance in particular, related to different things. But now we're going to kind of try to translate as many of those things into our own assumptions as possible. So we're going to start with the debt to equity ratio, as we usually do. The current market cap being $42.5 billion right now. You can easily see them having a pretty significant decline in their market cap, especially considering they're a volatile mining company. Even if it got cut in half, that would bring them down to $21 billion or so. And if they took on excess debt in relation to that, if they maybe even doubled their debt, if they doubled their debt but only came down about a third, I wouldn't say it's about half as much in that case, then perhaps that'd be like 15, 25, 10. So I could see maybe in a worst case scenario, you can see their debt to equity ratio coming up to like 25 to 30% or something, maybe even 40% in actually like a truly worst case scenario. Even 35 with a debt to equity ratio at 0 is probably super unlikely. The problem is that we're gonna have to adjust for the expected values, because when I do commodity companies, I don't actually adjust for the probabilities that I think they're going to do. I actually use a completely flat probability distribution because of the fact that I'm using the commodity price drivers. I try to have as agnostic of an opinion about what's going to happen with the commodity prices as possible, which means I end up using a completely flat probability distribution. So that means that whatever assumptions I put into all my best and worst case scenarios for things, I have to kind of take into account the fact that I can't adjust for the probabilities the way I normally like to do to make things like line up where I sort of want them to. So let's see, putting that at 30 and 0 and that at 10, that brings our expected value to 14%. I think that's pretty reasonable. Let's see, if I bring this up to 35, that brings it to 16%. I think that's pretty reasonable as well. Okay, so now we'll do the sales to capital ratio. This is going to be the part that it's going to probably help a lot. Well, actually, the margins will help a lot too. So as I was saying, with the total inventories, including non-current inventories of $4.3 billion, which is basically all the ore they have, and 3.5 years of, or so, 3.7 years of potential usage of the ore without using capital expenditure. And like I was saying, they're not really going to do that, but they could use maybe about half of that. So we can suggest that they can perhaps get essentially about 2 years of free sales to capital ratio. Is essentially what we're trying to say. Now we have to decide what we want their long-term sales to capital ratio to be. Now their industry sales to capital ratio is 0.64. relative to the 5-year average of 0.4 for them. I actually think going all the way to 0.64 for sort of like a mid number is pretty reasonable for them, especially considering the trend line they're on, the expectations for capital expenditures that they have. They've even said as much in their own expectations for their costs of capital. It's like they plan to do a decent amount of expenditures in this year, and then after that have declines in costs thereafter. So even in their own projections, they're suggesting that the sales capital ratio effectively should move up even if gold was to stay flat. Granted, they're not guiding gold to be flat, but that's the part where we do disagree with them. So maybe if we put the lowest level a little bit down further, because it doesn't have to be pretty low, and then the high levels are going to be much significantly higher. Let's see, so that brings the expected value to 0.5. We want it to go to 0.64 in the sort of mid-range. This is a little too high, but this needs to be maybe 0.75. Let's see. Oh, well, 0.64 is actually where we want to do maybe 0.3 or 0.35 as a lowest point. So this midpoint is still way too high. Six. Okay, so that's pretty fine for a default, I think. But now we have to adjust for the fact that, like I said, we're going to give them essentially 2 years of free sales of capital. Now, let me think. The amount that we're trying to target is 0.64, so then 128. Average of this year is 0.45, 0.51, 0.57. I know what I'm doing is a little weird, but it's kind of in my head, but I kind of have to like figure out what this would be in my head because I don't really have this built into the spreadsheet model. Let's actually go back to 1. Okay, so I'm fine with those sales to capital ratios assumptions. It's an elevated sales capital ratio assumption, but what it does is it's adjusting for the fact that that they have a large amount of iron ore that they're going to have to liquidate over the next several years. So now we'll move up to the margins, which is definitely something we need to put a pretty large increase on. The margin assumption for the worst case scenario, we're basically going to use as low of a point that we can while making the terminal value maintain a positive number, which 0 is currently suggesting that it would be negative because the 0 actually is representative of where the negatives are. So we'll just move it up ever so slightly until we find wherever that line is. Okay, 6% actually got us there, so it didn't really need to be that far. And then the highest bound, well, it actually needs to be way, way, way higher than that. It basically needs to be roughly in line with the highest levels of profitability they had, a little bit lower than that because they usually can't sustain quite as high as that. So that puts our expected value at 23%, which is definitely higher than the most recent few years, but it's on an expected basis. The analyst number will bring to 25%. Okay. You see what else needs to be adjusted. Okay, I think there's not much else I want to adjust other than the default risks. I think everything looks about right. Obviously the value is not looking very great, but the thing about that has to be taken into account is the high cost of equity. So we'll kind of talk about that a little bit when we get into this in full. But it's probably hard to see why something can be literally double its appropriate value currently, but yet still have forward returns. But that has to do with partially like how the discounting works. So we double check a couple last things, and then we'll do the default risk, and then we'll cover that. Okay, so we'll just do the default risk. I think everything else is fine. Okay, we can set it to 0 for the best case scenario and for the analyst model. And that improved their value a little bit because they did have a decent amount of value coming off because of that. Not a huge amount, but it did help a little bit. Okay, am I forgetting anything else that needs to be done to help them out here? I think about it. Okay. All right. So that is going to do it for us for GOLD, Barrick Gold Corp. A little bit of a complex thing we're going to have to explain here. As you can see, very overvalued, but still positive forward returns, which just comes down to discounting, but as we'll get into. U.S. Treasury selling for 2.15%. Mature market equity risk premium around 5.13% currently. I come up to a discount rate for Barrick Gold Corp of 23.15%. It is on the back of just frankly with the industry it's in, as we were saying, the unlevered beta for the industry being over 2 as a result of the huge volatility in gold mining companies, especially in the most recent year. That beta has moved up in particular. So it's just the way that we associate risks with companies makes this Barrick with a huge amount of debt, or with a huge amount of risk. Luckily for them, they don't have a large amount of debt, which would have been catastrophic for them. Any company in the same industry with a higher debt load would be facing an entirely different scenario that would be even more catastrophic. They have a dividend currently suggested of around 4%. That is based off of the assumption that they do pay out their performance dividend as it's currently slated. So it could technically be lower than that if their cash balances end up lower than that, or whatever. I kind of just put it in as the amount with the performance dividend because I do believe that they'll be paying that out for at least for the next year or so. So I think it's relevant at least for this valuation. So 5 years ago they had sales of $8.5 billion. In the most recent year it's $11.9 billion, which gave them 6 to 7% sales growth each year for the last 5 years. Sales capital ratio for the last 5 years on average has been 0.4. Relative to the industrial expectations of 0.64, so a bit low on that end, but we do believe that on average they'll move upward over the net of time. The returns on invested capital that we have for them is 7.64% for the 5-year period. Debt to equity ratio is about 11 to 12% or so. That's not netting out their cash. The default risk we have for them is pretty close to 0 for their most recent year period. Profit margins for the last 5 years on average has been 16% or so, relative to the industrial expectations of about 26%. So also relatively low on that end, just in the most recent year. But we do believe that they'll move upward towards those over time. The profit they had in the most recent year, $2.1 billion. They're currently selling for $23.87. So with our model, we are using a flat probability distribution that does not make assumptions about where the commodity price is going to go, as far as in particular of which particular price we think it will be. We do, however, have a range of gold prices based off of the methodologies that we described earlier, which gets us a range of anywhere from $292 per ounce 5 years from now to possibly $4,200 per ounce 5 years from now. On an expected basis, we end up with just over $2,000 per ounce. The revenues we get based off of this this gold price suggested is $4.9 billion in the worst case scenario to possibly $24.6 billion in the best case scenario. On an expected basis, we see $13.7 billion, which gets us sales growth of anywhere from negative 16% per year to possibly positive 15 to 16% per year. On an expected basis, we see about 2 to 3%. So the sales to capital ratio is a range of 0.5 to 2. On an expected basis, it comes out to closer to about 0.5, but there is the extra boost in there that has to do with the extra stockpiles of ore that they have on deck. Returns on invested capital, we have a range of anywhere from 1% to almost 30%, which gets us to an expected value of 13 or so percent. The debt to equity ratio, we have an expected value of about 16%, which could come on the back of them issuing more debt or their market cap declining pretty significantly. The default risk we have for them is 1.59%, which is a little bit high, but it's actually really just on the back of their worst case scenario, which is with the gold price drops to pretty catastrophic levels. Beyond that, the default risk is actually pretty negligible. So the profit margins, we have a distribution of anywhere from 6% to 35% in the best case scenario, which on an expected basis, we have possibly about 25%. So that gets us a profit distribution of anywhere from $294 million in the worst case scenario to possibly $8.6 billion in the best case scenario. On an expected basis, we see $3.5 billion. So we have a present value price after using the discount rate that we are adjusting for, which gets us a suggested value of $13.39 per share, which is 43 to 44% lower than the current share price. Based off of the discount we're using, we have 5-year forward value targets unadjusted for the dividends that they'll pay out during the period, which will actually have a pretty significant effect on the price. So every time they pay out a dividend, you have to subtract it out of this number effectively. Of anywhere from worst case scenario of $18.97 to possibly $65.16 per share. On an expected basis, we see $37.92 per share. So this is where things get a little bit complicated because there's kind of two ways to look at this. On one hand, it's extraordinarily overvalued in the present value sense. On the other hand, it's pretty undervalued on the 5-year forward value target sense, as well as on a relative risk potentiality sort of sense. And what I mean by that is that, I mean, look at this. If you believe that the price is going to adjust to this discount rate in the very, very immediate future, to actually go back to a present value, if you think the market is actually going to imply a 23% discount into this stock, then it's really only worth $13.39 per share. But that implies that that's there. It means that at $13.39 per share, it would be fair value and still giving you a 23% return. You know, a fair value stock giving you 23% return. Now, this is based, like I said, off of the industry risk. I don't think that the risk to gold, in particular Barrick, is that high. So this is part of the reason I like to look at the 5-year forward value target, because the 5-year forward value target it takes this valuation into account, but then it also adjusts for the fact that it's going to get this return 5 times over before it gets to that year. So yeah, it's only worth $13.39 right now with a 23% discount rate, but after you've earned that 23% per year for 5 years, on top of being 43% undervalued, you still end up at $37.92, which is still a 9 to 10% return per year. So it's probably, that's, you know, you have to understand how discounting works for that concept to make sense. But that's why this is a long way for me to say that this is a company I own personally, much like Shell that I talked about, I also own personally. And after getting to evaluation on that stock, I did end up saying, oh wow, I guess I'm going to be selling it. But the thing about that was that it wasn't quite as big of a difference, and the valuation spread was also a little bit different as well. In fact, I'm going to go ahead and pull it up just so that I can kind of make my point with that a little bit better. Where'd it go? Chill. I'm blind. Where'd it go? Okay, so here we are. So in Shell, with my valuation in Shell, I said that it was 37% overvalued, but there's a 10% rate in there. So even though it was highly overvalued here, the forward value target I still had was still at 51.54. So it still suggested that the value was still pretty well baked in. And this gets to the second point with gold, was that there's also a range of prices that are available to me. It's not just the one outcome on the expected value that matters. It also matters the range of outcomes and how that correlates into the potential for returns or not. Because if you look over at Shell, for example, the range of outcomes, yeah, well, in the best case scenario, in the very best case scenario, there was lots of returns eventual. So somebody might look at me 3 years from now, if Shell ends up at $100 per share, they might say, ha, you were stupid. You sold Shell when it was 50, when you could have gotten $100 per share. But I would say, yes, but I also could have lost $40 per share off the fact that the 5-year forward value target was 9 on the worst case scenario. So the range of outcomes in Shell is really, really, really wide. While in gold, you'll notice that the range of outcomes is still pretty wide, between $19 a share and $65 a share. But that worst case scenario, $19 per share, is not nearly as bad compared to the current price. That would be like losing 20-25% over a 5-year period. As a worst case scenario, versus the worst case scenario in Shell was losing 75-80%. So a worst case scenario with a 23% discount rate of getting to a 25% loss in a 5-year period. And that also implies that the 23% discount rate would be continuing forward after that as well in the perpetual growth. So this model, while it seems like it's saying, oh, Barrick's crazily overvalued, it's saying it's crazily overvalued if you believe that it has exactly this much risk and if you demand this much return. So if you're willing to accept 9 to 10% return for the next 5 years, but then have an implied 23% return baked into everything thereafter, then Barrick is still a good value. That's basically the point I'm trying to say. Now, this isn't actually a recommendation for anybody. None of my valuations are actually recommendations for anybody. I'm not recommending you go out and buy this stock. I personally own this stock, and I'm explaining why I'm not going to sell it. That's basically what I'm explaining to you right now, is that I have no intentions of selling Barrick until it's at least close to this price. Because it doesn't matter that this is so highly overvalued, because it implies this much return. And I'm willing to take a 44% short-term loss in order to get a long-term 23% return perpetually. And that's what this valuation implies. So you have to understand the difference between present value and forward value in relation to the present value formula and how discounting works in order to get this concept. So with that though, it's still not a very good value for somebody who isn't in the stock and hasn't taken it onto that risk. I started buying this stock when it was like $11 a share. And then my average cost, I think, is around $18 a share right now or something, which is pretty great considering the 5-year forward value target is still higher than that. So I certainly won't be buying the stock. I'm definitely not recommending other people go out and buy more of the stock right now. But if you already own the stock, I absolutely would not be selling it unless it comes closer to this, adjusted for dividends. Because again, dividends have to be adjusted for that. So with that though, the value score that I come up with my own personal number based off of all sorts of ranges of potential targets, absolute returns, relative returns, the sales capital ratio, returns invested capital, and profit margins. I come up with 0.45, which is also not a screaming buy by my own general metrics. Usually things aren't really a good buy unless they're north of 1. So definitely doesn't look like something to go out and buy, but it's definitely not something to sell, according to what I say. Based off of short-term pricing, which is multiples regressed against the S&P 500 based off of the fundamentals of gold, it gets a suggested price of $49 per share. But that also has to do with the fact that mining companies typically do trade at pretty low multiples. So that's going to typically show that the likelihood that that would happen, go all the way up to 49 based off of multiples in the short run, I think is pretty unlikely. Though in the long run, it still fits within the range of value potentials. So with that, that's going to do it for today. A bit of a long discussion covering a lot of random other stuff related to the gold pricing, as well as making sure the valuation is right. And then I had to make sure everybody understands that discounting method, because obviously on one hand my valuation says it's crazy overvalued, but on the other hand it suggests that there's lots of potential forward returns. So you have to understand, I guess, the short-term mindset versus the long-term mindset, and the bridge between the two. So as I said at the start of the stream, we are expecting to do Jeffries on Monday. I've got most of the prep work already done for that one, so even if one of my other few stocks that haven't been covered yet were to come out now and then, I honestly don't have enough time to switch between then and now. So it's basically for sure going to be Jeffries on Monday, though after that, who knows, we'll get into it then. So if you've been watching up to this point, please like the stream, subscribe to the channel if you're not already, follow all those other things. All my social links can be found in the description below. We're very much trying to grow, and we need your help to do that. So please do those things, and catch me next